Hi guys! Enjoy John's analysis.
The current U.S. economy is essentially a Ponzi scheme, relying on foreign countries continuously buying dollars to keep it running. That sentence was not published in an academic journal. It was not said by a former Federal Reserve chairman, a Goldman Sachs analyst, or a senator sitting on the finance committee. It was said by a high school teacher in Beijing, a man who, in July of 2024, stood in front of a classroom and made 3 predictions that would make him the most watched geopolitical analyst on the internet by 2026. Prediction 1, Donald Trump would win the November election. Prediction 2, the United States would go to war with Iran. Prediction 3, the United States would lose that war, and the loss would forever change the global order. 2 of those 3 predictions have already come true in the exact sequence and manner he described. And the third is unfolding right now, in real time, in the most consequential way possible. Because what is happening at the Strait of Hormuz is not just a military story, it is a monetary story. It is the story of a dollar system that was already dying, being shown the exit door by a country that had 8 years to build the alternative, and chose Bitcoin to do it. By the time you finish this video, you will understand 5 things that almost nobody in mainstream finance is connecting right now. You will understand exactly how the dollar system works as a contract, backed by military enforcement, in Professor Jiang's own words, verified and sourced. You will understand why that contract is breaking, not tomorrow, not in 10 years, but in the data that is being published this week. You will understand why no country on earth can replace America as the global reserve currency, and why that gap is the most important structural fact in monetary history. You will understand why Iran specifically chose Bitcoin over USDT, over yuan, over gold, and what that choice means for every other sanctioned nation watching right now. And you will understand what 1% of the dollar system's total size means when it looks for an exit, and why the supply of Bitcoin cannot absorb that demand at any price close to today's. Stay until the end. Not because this channel is telling you what Bitcoin will do next week, but because what Professor Jiang taught his class in 2024, the map he drew that 2 out of 3 predictions have already validated, leads to one conclusion he never explicitly reached. And this video is that conclusion. Professor Jiang Suiqin is a Chinese-Canadian educator based in Beijing, where he teaches history and philosophy at a private high school called Moonshot Academy in the Chaoyang district. He holds a bachelor's degree in English literature from Yale University, graduated in 1999, and has spent most of his career in education reform in China. He is not a geopolitics professor, not a military strategist, not a credentialed economist, and the mainstream establishment has made sure to note that distinction loudly and repeatedly since his predictions began coming true. He calls his methodology predictive history, a framework that treats geopolitics as a game played by rational actors maximizing self-interest, analyzed through structural patterns rather than ideology. In a lecture he gave in January 2026, he described it this way. He does not use ideology, he does not use emotion, he uses game theory and he focuses on self-interest. The question he asks is not what does a player say, it is what does a player do when their interests are maximized. Using that framework, in a classroom lecture posted to his YouTube channel, Predictive History, in May 2024, he made his 3 predictions. Trump would win. The US would go to war with Iran. The US would lose. On November 5th, 2024, Trump defeated Harris. On February 28th, 2026, the United States and Israel launched coordinated strikes against Iran. The 3rd prediction is still unfolding, but Professor Jiang's analysis of what that 3rd outcome produces is the architecture this video is built on. Because what he described, the collapse of the petrodollar, the end of dollar dominance, the fracturing of the global monetary order, is not theoretical anymore. It is happening in the data, confirmed by sources from Bloomberg to the Congressional Budget Office, and it leads directly to Bitcoin in a way that Professor Jiang himself has only partially articulated. This channel will finish the map he started, using his framework, using verified data, and arriving at the conclusion his map demands, but his lectures have not fully delivered. Professor Jiang's most precise statement about how the dollar system works came in a lecture where he described it in terms any viewer can verify. He said, "The US dollar is a contract system. When you use the US dollar, it is a contract that trade will be honored. And with a contract system, you also need an enforcement mechanism, meaning if you don't honor the contract, someone has to come beat you up. Otherwise, you'll just ignore the contract. That is what the US military is for. This is not conspiracy theory. This is documented history." In 1971, President Nixon dissolved the Bretton Woods system in an 18-minute televised address, ending the dollar's convertibility to gold. The world held dollars that were no longer backed by anything except the continued willingness of other nations to accept them. 3 years later, in 1974, Secretary of State Henry Kissinger struck a secret deal with Saudi Arabia. a deal that Bloomberg described this week as one of the most consequential financial deals in modern history. Saudi Arabia would price its oil exclusively in US dollars and recycle the surplus revenues into US Treasury securities. In return, America would provide security guarantees and maintain a global order stable enough for that recycling to continue. Other Gulf states followed. The petrodollar system was born, and with it, the enforcement architecture that has sustained dollar dominance for 50 years. The mechanism that Fortune described in a March 2026 analysis is precisely what Professor Jiang described in plain language. The Gulf states sell their oil in dollars. Every nation on Earth that needs energy must first acquire dollars, generating permanent structural demand for American currency. The GCC then reinvests its enormous oil revenues back into American financial markets, into the technology stocks, the data centers, the AI infrastructure that underpins American economic power. Saudi Arabia alone held $149.5 billion in U.S. Treasury securities as recently as December 2025. The loop is elegant and self-reinforcing. As long as the U.S. military can guarantee that the Strait of Hormuz remains open, that the GCC is protected, and that no rival power can disrupt the flow of oil priced in dollars, that guarantee is the dollar. The military is the enforcement. And without the enforcement, there is no contract. Professor Jiang's most provocative claim, that the U.S. economy is essentially a Ponzi scheme relying on foreign countries continuously buying dollars, sounds incendiary when a Beijing-based teacher says it. It sounds significantly less incendiary when you read the Congressional Budget Office's February 2026 outlook, which projects the federal deficit will reach $1.9 trillion in fiscal year 2026 and swell to $3.1 trillion by 2036. It sounds even less incendiary when you read Fortune's March 2026 report, confirming that the U.S. national debt crossed $39 trillion on March 17, 2026, adding $4.5 trillion in just 2 years, without a recession, without a large stimulus package, without a full-scale military operation. The debt numbers have reached a level where the Congressional Budget Office's own projections confirm that debt held by the public will surge from 101% of GDP today to 120% of GDP by 2036, eclipsing the previous all-time record of 106% set just after World War II. Net interest payments on the national debt are projected to exceed $1 trillion in fiscal year 2026, nearly triple the $345 billion the government paid in 2020 at the onset of the pandemic. In the first 3 months of fiscal year 2026 alone, net interest payments reached $270 billion, already surpassing the nation's defense spending for the same period. The former president of the Dallas Federal Reserve, Robert Kaplan, told Bloomberg in January 2026, "We have in the United States $39 trillion of debt, on its way to $40 trillion plus. And when you have that much debt, I think stability of the currency probably trumps exports." A budget watchdog report published by Fortune on March 27, 2026, stated there is no silver lining in this trajectory, warning of possible financial crisis, inflation crisis, or currency crisis ahead. Professor Jiang called it a Ponzi scheme. The Congressional Budget Office called it alarmingly high debt levels. The former Fed president called it a stability risk. The architecture is the same description. The only difference is the vocabulary used to deliver it. Here's the argument that Professor Jiang made in his game theory lecture, the one that most people miss because they get distracted by his more provocative claims. He said, in the clearest terms possible, no country will replace America as the global reserve currency. Not China, not Russia, not a BRICS coalition, not anyone. The reason, he explained, is that being the global reserve currency is extraordinarily expensive. You absorb all the risk of the global financial system. You must be willing to fight wars anywhere in the world at any time to enforce the monetary contract. And your domestic population must absorb the cost of excess global liquidity, which produces financialization, inflation, and the hollowing out of the manufacturing base. America did not choose this burden rationally. It accumulated it historically. And it is, in Professor Jiang's words, unbelievable that America agreed to the system in the first place. The data confirms this analysis with precision. Fortune's March 2026. Analysis noted that the Chinese yuan, despite years of BRICS advocacy and aggressive promotion of yuan-denominated oil contracts, represents just 2.1% of global reserves. The euro holds second place at approximately 20%, but no single currency has emerged as a credible heir apparent. Bloomberg confirmed on April 6, 2026. The virtuous loop that has seen America underwrite stability in the Middle East in exchange for Gulf states recycling their dollar revenues into U.S. treasuries has been broken. But it has been broken without a replacement. The petrodollar is fracturing without another petrosystem emerging to take its place. This is the gap that makes Bitcoin's position structurally unique. Every previous monetary transition in history, from sterling to dollar, from gold standard to Bretton Woods, from Bretton Woods to petrodollar, required another sovereign power to step in and absorb the cost of being the reserve system's anchor. Sterling gave way to the dollar because America had 2/3 of the world's gold and the world's largest intact industrial base. There was a willing, capable replacement. Today, there is no willing replacement. There is no country that wants to take on $39 trillion in debt service obligations, plus the cost of being the world's police force. That vacuum, the gap between a dying reserve system and the absence of a replacement, is the most important structural fact in global monetary history right now. And Bitcoin is the first monetary instrument in the history of civilization that does not require a sovereign to absorb that cost, because it has no sovereign. The mechanism Professor Jiang described, GCC sells oil in dollars, GCC recycles dollars into American economy grows, dollar stays strong, is not just theoretically under threat. Bloomberg published a headline on April 6, 2026 that deserves to be read carefully. The petrodollar loop supporting the treasury market is broken. Not fraying, not weakening, broken. The article traced the origins of the loop to 1974 when Kissinger struck the deal with Saudi Arabia, and then confirmed that the conflict at the Strait of Hormuz has severed the mechanism that has sustained American borrowing capacity for 50 years. The Minority Report publication, analyzing Professor Jiang's framework in March 2026, documented the cascade precisely. The GCC states imported 80% of their food, desalinated most of their water, ran on a single export denominated in a single currency, backed by a single military guarantee. Destroy the GCC's ability to generate and invest petrodollars, through military strikes, through closing the Strait of Hormuz, through destroying desalination plants and making these cities uninhabitable, and the cascade is immediate. Oil flows stop. Petrodollar recycling stops. GCC investment in American markets stops. The technology stocks that have driven American market growth for a decade collapse in value. Professor Jiang described this exact chain of events in his March 3, 2026 interview on Breaking Points, and 5 days later, on March 8th, Iran attacked a desalination plant in Bahrain. The professor said in that same interview, the Gulf states are really the linchpin of the American economy. What they do is they sell petrodollars, and then they recycle the petrodollars back into the American economy for investments in the stock market. And right now we know that the entire American economy is propped up by investments in data centers, and a lot of that comes from the Gulf states. So if the Gulf states are no longer able to sell oil, and they're no longer able to finance AI, this AI bubble in the United States will burst, and with it will burst the entire American economy, which is really a financial Ponzi scheme. He is not predicting this will happen eventually. He is describing what is already happening in the Bloomberg headline, in the Strait of Hormuz closure, in the Brent crude price above $111 per barrel, in the CPI data showing headline inflation at 3.3%, the highest since 2021, driven primarily by energy costs from the conflict. If you've reached this specific checkpoint, I want to acknowledge your intellectual stamina. We are deep into the geopolitical architecture that 99% of the market is too distracted to see. To help me calibrate the reach of this signal as we analyze the petrodollar fracture, comment your city, the exact local time, and the weather where you are right now. Whether you are in a high-rise in Sao Paulo or a desk in Singapore, I want to see the global distribution of the engineered markets community. This is our baseline. Comment below. There is something Professor Jiang did not say in any of his lectures. Something his framework demands, but his analysis stops short of reaching. If the dollar system is dying, if the petrodollar loop is broken, if no country will replace America as reserve currency, if the enforcement mechanism is failing, then where does the money go? $39 trillion in U.S. national debt, trillions more in foreign-held dollar reserves, the sovereign wealth funds of nations that have spent decades accumulating dollar assets because there was no alternative. When those nations start reducing their dollar exposure, not in a panic, not all at once, but in the gradual, rational reallocation that every prudent reserve manager will eventually make. Where does that capital flow? Not to the yuan, not to the euro, not to gold alone, because gold cannot be sent across borders instantly, cannot be verified cryptographically, and can be seized by any government with the physical force to do it. Professor Jiang gave you the map. He described the problem with extraordinary precision. He validated the framework with 2 out of 3 predictions already confirmed. But his map ends at the edge of the territory where Bitcoin begins. This channel will now show you exactly where the map leads. Block 6. The Bitcoin conclusion. Jiang's framework demands. Professor Jiang described the dollar as a contract requiring military enforcement. Bitcoin is a contract that requires no enforcement because it is enforced by mathematics running on thousands of computers simultaneously in dozens of countries, with no headquarters, no CEO, no board of directors, and no government that can press a button to freeze the funds. He described the petrodollar system as a mechanism where every nation on earth must accumulate dollars to buy oil. Bitcoin is a settlement mechanism that requires no nation to be privileged because the rules are identical for every participant, regardless of military power, regardless of GDP, regardless of whether your country's banks are connected to SWIFT. He described America's $39 trillion debt as a Ponzi scheme requiring foreign buyers to continuously roll over the debt. Bitcoin has 21 million units fixed permanently in the protocol, with no issuer that can print more, no government that can devalue it, and no Sunday night television address that can dissolve it. And crucially, he described in his lecture how the dollar system functions because no country will accept the cost of replacing it. Bitcoin is the first monetary instrument in history that removes the question of which sovereign accepts the cost, because Bitcoin has no sovereign. No country is asked to run deficits, maintain a navy, or guarantee the security of oil choke points in exchange for Bitcoin being the reserve asset. The protocol runs whether or not any government endorses it. It ran while the United States was trying to ban it. It ran while China was banning it. It ran while Iran was cut off from SWIFT and used it to collect tolls on the world's most important oil choke point. Bitcoin does not need a sovereign to function. That is precisely the property that makes it the only credible alternative to a dollar system that is failing because its sovereign can no longer bear the cost. Block 7. The 1% calculation. Now this channel will run the mathematics that Professor Jiang's framework implies, but never explicitly calculates. The total size of the dollar system, the dollar-denominated assets held globally, including foreign exchange reserves, treasury securities, dollar-denominated debt, and dollar-priced commodity contracts, is measured in the tens of trillions of dollars. The IMF data shows that the dollar's share of global foreign exchange reserves, while declining, still represented approximately 57.4% of total global reserves in the most recent reporting period, representing approximately $6.6 trillion in foreign-held dollar reserves alone. This does not include dollar-denominated sovereign debt held by foreign governments, dollar-priced oil contracts, dollar-denominated corporate debt issued by non-U.S. entities, or dollar-priced commodity derivatives. The total dollar-denominated financial system is substantially larger, measured in terms of hundreds of trillions of dollars in notional exposure when derivatives are included. This channel will use a conservative base of the $6.6 trillion in foreign-held dollar reserves that foreign central banks and sovereign wealth funds are explicitly holding as reserve assets. 1% of $6.6 trillion is $66 billion. That is the demand figure. $66 billion of capital looking for an alternative reserve asset. Against that demand, approximately 2.2 million Bitcoin available on centralized exchanges as of March 2026, the lowest level since December 2017, according to CryptoQuant data confirmed by multiple analytics firms. At Bitcoin's current price of approximately $72,000 per coin, the entire exchange-held supply of 2.2 million Bitcoin is worth approximately $158 billion, the total liquid market. $66 billion of demand from a 1% reallocation of foreign dollar reserves alone represents more than 40% of the entire liquid Bitcoin supply on Earth. That is not a price prediction. That is arithmetic applied to documented numbers. And the $66 billion is the conservative case, using only foreign-held reserves, not dollar-denominated sovereign debt, not petrodollar recycling flows, not the sovereign wealth funds of BRICS nations, not the retirement accounts of American citizens seeking a hedge against dollar debasement, not the demand from nations that just watched Iran use Bitcoin to collect tolls at the Strait of Hormuz. The demand side of this equation is not $66 billion. It is the entire population of dollar-denominated assets in a world where Professor Jiang's map is correct, and 2 of his 3 predictions have already been confirmed. Block 8, the supply architecture at the most critical moment. This channel has documented Bitcoin's supply architecture across multiple videos. The data remains consistent, and the trend continues. As of April 2026, approximately 19.8 million Bitcoin have been mined, approximately 94% of the 21 million total that will ever exist. The April 20th, 2024 halving reduced daily new issuance from approximately 900 Bitcoin per day to approximately 450 Bitcoin per day. According to Fidelity Digital Assets research sourced by Glassnode and documented by BitGo, 566 Bitcoin per day are aging into the ancient category. Coins unmoved for over 10 years, compared to 450 Bitcoin per day now being produced by miners. Supply is contracting in net absolute terms before a single institutional dollar enters the market. Exchange reserves stood at approximately 2.2 million Bitcoin as of March 2026, the lowest level since December 2017, according to CryptoQuant data confirmed by Spotted Crypto in the Crypto Times. The total U.S. spot Bitcoin ETF market held over $100 billion in assets as of early April 2026, with the 11 existing ETFs collectively holding approximately 1.3 million Bitcoin in cold custodial storage that does not return to exchange order books. Strategy, formerly MicroStrategy, held 762,000 Bitcoin as of April 2026, purchased at an average cost of approximately $75,694 per coin under an explicit mandate that does not permit selling. Combined, the ETFs and strategy alone have already removed approximately 2.1 million Bitcoin from the tradable supply, nearly the entire amount remaining on exchanges. Morgan Stanley launched MSBT on April 8, 2026, the first Bitcoin ETF ever issued directly by a major U.S. bank, with the lowest fee on the market at 0.14%, giving 16,000 financial advisors direct access to $9.3 trillion in client assets. The SEC Clarity Act Roundtable is scheduled for April 16th. The U.S. Strategic Bitcoin Reserve, established by Presidential Executive Order on March 6, 2025, holds approximately 207,000 Bitcoin forfeited through criminal proceedings, with an explicit mandate to never sell. The supply architecture has never been more constrained. The institutional access infrastructure has never been more developed, and the sovereign validation signal from both the U.S. government buying Bitcoin and Iran using Bitcoin to control the world's most important oil choke point has never been more explicit. This channel uses Professor Jiang's framework as a map to navigate to a destination he has never visited. This is not a criticism, it is an honest description of what the engineered market's editorial framework has always been. When Professor Jiang says the petrodollar is dying, he is correct, and Bloomberg, Fortune, and the Congressional Budget Office confirm it. When he says no country will replace America as reserve currency, he is correct. And the IMF data on UN share and Euro share confirms it. When he says the U.S. economy is a Ponzi scheme dependent on foreign buyers of dollar assets, he is describing a structural vulnerability that the CBO projects will produce $1.9 trillion in annual deficits in 2026 alone. What Professor Jiang does not say, what his framework implies but his lectures have not reached, is that the gap between a dying reserve system and the absence of a sovereign replacement is precisely the gap that Bitcoin was designed to fill. Not by any government's design, not by any central bank's plan, but by the mathematical logic of a protocol that was built in 2008, specifically because the dollar system had shown in the bailouts of that year that it would always protect the institutions that owned it and burden the people who used it. The Ponzi scheme that Professor Jiang describes is the same system that Satoshi read about in the Times of London on January 3rd, 2009, the headline embedded permanently in the Genesis block. Professor Jiang is using his map to show you that the dollar is dying. This channel is using his map to show you what lies after it. This channel always presents the bear case. Here it is in full. Professor Jiang's analytical framework, while compelling in its predictions, rests on structural pattern recognition rather than peer-reviewed academic methodology. His title is a brand rather than an academic appointment. He is a high school teacher and commentator, not a credentialed geopolitics scholar, and some of his broader claims about secret societies, esoteric control structures, and religious eschatology are not verifiable and should not be treated as evidence. This channel uses only the elements of his framework that are independently confirmed by primary sources: the petrodollar mechanism, the dollar reserve dynamics, the U.S. debt trajectory, and the strategic logic of the Iran conflict. The conspiratorial elements of his worldview are not used and are explicitly disclaimed. The Bitcoin supply shock argument has a structural bear case that must be stated. 1% of foreign dollar reserves seeking Bitcoin does not mean $66 billion enters the market tomorrow. Reserve reallocation happens over years, not weeks. The Bitcoin ETF market, for all its structural strength, has experienced net outflows exceeding $5 billion since November 2025, indicating that institutional demand, while present, is not uniformly accelerating. The ceasefire between the United States and Iran is 2 weeks old and fragile. If it holds and the Strait of Hormuz reopens fully, some of the geopolitical pressure driving the petrodollar fracture narrative may temporarily ease. And the Clarity Act, while scheduled for roundtable on April 16th, still faces stablecoin yield disputes that could prevent passage before the midterm election cycle consumes Senate floor time. The Bitcoin price itself is 46% below its October 2025 all-time high of $126,000. The Fear and Greed Index has registered extreme fear for 49 consecutive days as of early April 2026. Every argument this channel makes about supply architecture and structural demand is a long-duration thesis. It describes the direction of forces, not the timing of outcomes. This channel does not give price targets. It does not tell you what Bitcoin will do next month. What it tells you is what the architecture looks like, and the architecture, built from Professor Jiang's verified framework combined with on-chain supply data and institutional flow data, points in one direction with a clarity that neither the bull case alone nor the bear case alone can fully account for. Professor Jiang's framework predicted that Iran would be the pivot point of the global monetary transition. He said explicitly in his lecture that Iran is the pivot of the world, that if you can destroy Iran, it is very hard for China to access the Belt and Road and very hard for Russia to trade with Africa. What he did not predict, and what his framework did not anticipate, is that Iran would provide the most operationally significant validation of Bitcoin's core property that has ever occurred. On April 8th, 2026, the same day Morgan Stanley launched MSBT, the same day Bitcoin briefly touched $72,000, Iran's National Security Committee had already passed legislation formalizing a Bitcoin toll system at the Strait of Hormuz into law. The toll, $1 per barrel of oil, for a very large crude carrier carrying 2 million barrels, $2 million per transit. Accepted specifically in Bitcoin because, as spokesperson Hamid Hosseini told the Financial Times directly, vessels would be given a few seconds to pay in Bitcoin, ensuring they can't be traced or confiscated due to sanctions. Not USDT, because Tether had already frozen over $3.3 billion in Iran-linked wallets, including 42 IRGC-linked addresses in its largest ever sanctions. Enforcement action in July 2025. Not yuan, because the yuan clearing system still routes through correspondent banks that can be pressured. Bitcoin, because Bitcoin has no issuer, no compliance department, no board of directors, and no government that can press a button to stop a transaction mid-settlement. Chainalysis, in its April 10, 2026 analysis, called this development a significant milestone, the first known instance of a nation-state demanding cryptocurrency as payment for transit through an international waterway. The country that the dollar system tried to financially destroy, cut off from SWIFT in 2018, every major bank fined billions for processing its transactions, its currency losing 96% of its value against the dollar, chose Bitcoin as its sovereign payment instrument at the world's most important energy choke point. Not because Bitcoin is fashionable, not because of the halving cycle or the ETF narrative, because Bitcoin is the only monetary instrument on Earth that the enforcement arm of the dollar system, the US Treasury, Tether, SWIFT, the correspondent banking network, cannot unilaterally block at the moment of transaction. Iran proved Satoshi's thesis under the most adversarial conditions imaginable. And every other sanctioned nation, every BRICS member watching the dollar's reserve share decline, every central bank that has read Professor Jiang's analysis of the petrodollar's structural vulnerability, they all watch the same proof of concept. Professor Jiang said the dollar is dying. He said no country will replace it. He said the American economy is a Ponzi scheme dependent on foreign buyers. He was right on 2 of 3 predictions. He used a map to navigate the present, connecting the past, explaining the now, and pointing toward the future. He drew a map that ends at the edge of a territory he has not explored. This channel has been exploring that territory for years. The territory is the supply architecture of an asset with 21 million units, fixed by mathematics, declining in available inventory to the lowest level since 2017. The territory is the institutional infrastructure, $100 billion in ETF assets, Morgan Stanley distributing Bitcoin to $9.3 trillion in client assets, the US government holding a strategic Bitcoin reserve and calling it digital gold. The territory is the sovereign validation, the country that built the dollar system holding Bitcoin as a reserve asset, and the country the dollar system tried to destroy using Bitcoin to run the world's most important oil choke point. The loop closes like this. Professor Jiang says the dollar is dying, verified by CBO, Fortune, Bloomberg, and the petrodollar fracture data of April 2026. He says no country will replace it, verified by IMF reserve share data showing the yuan at 2.1% and no credible heir apparent. He says the enforcement mechanism is failing, verified by the Strait of Hormuz closure, the Bitcoin toll system, and the formal acknowledgement by Bloomberg that the petrodollar loop is broken. And this channel says, when a system with $39 trillion in debt, $6.6 trillion in foreign reserves, and decades of recycled petrodollar flows looks for an exit, the exit that requires no sovereign, no enforcement mechanism, and no contract that a president can dissolve in 18 minutes on a Sunday night, has 21 million units, 2.2 million of which are available on exchanges, and 337,000 of which disappear into cold storage every time a dollar of institutional demand enters the market. 1%. That is all it takes for the mathematics to become impossible. 1% of the money in a dying system finding the only exit that has no door that can be closed. Professor Jiang drew the map. Satoshi built the exit. The supply does not exist to absorb both. This channel does not give price targets. What this channel does is read the architecture. the verified structural forces operating on the supply and demand equation, and let the mathematics speak. The architecture, as of April 11th, 2026, is as follows. Professor Jiang Shui-Chin, a teacher whose two confirmed predictions about Trump and the Iran war have made him the most watched geopolitical analyst on the internet, has documented the structural failure of the petrodollar system using game theory and verified historical pattern analysis. The U.S. national debt crossed $39 trillion on March 17th, 2026. Annual interest payments now exceed $1 trillion, more than the entire defense budget. Bloomberg confirmed on April 6th that the petrodollar loop supporting the treasury market is broken. The Chinese yuan holds 2.1% of global reserves. No sovereign replacement exists. Against this backdrop, Bitcoin's exchange reserves stand at 2.2 million coins, the lowest since December 2017. The institutional infrastructure includes $100 billion in spot Bitcoin ETFs, Morgan Stanley's MSB, as the first bank-issued ETF, with 16,000 advisors and $9.3 trillion in client assets, and the U.S. Strategic Bitcoin Reserve. 566 Bitcoin per day are aging into permanent illiquidity versus 450 new coins being mined. Net supply contraction in absolute terms. Iran has passed parliamentary legislation making Bitcoin the sovereign payment instrument for the world's most important oil choke point. The first documented sovereign use of Bitcoin as a geopolitical instrument at global scale, confirmed by Chainalysis, TRM Labs, the Financial Times, CoinDesk, and The Block. 1% of foreign dollar reserves seeking a non-sovereign alternative produces $66 billion of demand against a liquid supply worth $158 billion, and that supply is declining by tens of thousands of coins every month before a single institutional dollar is allocated. Professor Jiang used his map to show you the dollar is dying. This channel used his map to show you where the money has to go. The supply does not exist to absorb what the mathematics demands. The architecture is assembled, the direction is documented, and the exit has been operational, confirmed under the most adversarial conditions in human monetary history, since April 8th, 2026. The primal timber is old, it is dense, and it was here long before the war. Professor Jiang drew the map. Satoshi built the exit. The supply does not exist to absorb both. To those of you reaching this final second, respect. You have just completed the most comprehensive audit of the global monetary transition available on this platform. Your attention span is officially institutional grade. In an era of 60-second noise, your ability to process these 45-minute architectural shifts is your greatest unfair advantage. You don't just see the price, you see the diamond. Here is your final directive. To signal that you are part of the elite 1% who decoded the mathematics of this transition, comment the code EXIT21 below. This is our internal handshake. It tells me who the true researchers are in this community. Head to the pinned comment, verify the sources, and trust the physics of the situation. The map is in your hands.